bookkeeping, accounting, journals, discounts, accruals, prepayments, bad debts, depreciation. Bookkeeping, source documents, journals, ledgers, trial balance. These books record transactions, balance accounts, check for errors, and correct them. Accounting, income statement, balance sheet, cash flow statement. These are financial statements that show the profitability, financial position, and liquidity of a business. Capital expenditure. Capital is invested to own assets and pay back liabilities, items that appear in the balance sheet. Revenue expenditure. Expenses incurred to earn an income, items that appear in the income statement. Cash and cash equivalent. Assets that can be turned into cash easily, items that appear in the cash flow statement. Journals. Sales, purchases, returns inwards, returns outwards, cash book, general. Goods for resale on credit are recorded in the sales, purchases, returns inwards, and returns outwards journals. All cash transactions are recorded in the cash book. Non-cash and non-goods for resale transactions are recorded in the general journal. SGI Limited provides you, the bookkeeper, with source documents to prepare the journals. Label each transaction with the appropriate journal. December 1st, business opened with building, equipment, motor vehicle, prepaid expense, debtors, cash at bank, cash in hand, bank loan, and creditors. Opening books, general journal. 3rd, bought goods for resale on credit from A Limited with a list price, less trade discount, goods on credit, purchases journal. 5th, cash sales, cash is received, cash book. 6th, returned some goods to A Limited with trade discount on list price, goods on credit, returns outwards journal. 8th, sold goods on credit to B Limited with a list price less trade discount, goods on credit, sales journal. 11th, deposited cash in hand into bank account, cash gives and bank receives, cash book. 15th, B Limited returns some goods with trade discount on list price, goods on credit, returns inwards journal. 17th, purchased goods from C Limited and paid with a check, check is bank, cash book. 19th, paid cash to C Limited for delivery of purchased goods, cash is spent, cash book. 20th, paid cash for salaries, phone and internet, cash is spent, cash book. 22nd, customer paid in advance with a check for goods, check is bank, cash book. 23rd, purchased equipment on credit from D Limited, no goods, no cash, general journal. 25th, paid cash to A Limited to clear debt on December 3rd and received a discount, cash is spent, cash book. 26th, received check from B Limited for goods bought on December 8th and gave them a discount, check is bank, cash book. 28th, paid insurance for this period and the next period, cash is spent, cash book. 29th, received an invoice from Light Limited for due electricity bill, no goods, no cash, general journal. 30th, owner withdraws cash for personal use, cash is spent, cash book. 31st, bad debts are written off and depreciation is charged, no goods, no cash, general journal. Draw up the journals. December 1st, business opened with building, equipment, motor vehicle, prepaid expense, debtors, cash at bank, cash in hand, bank loan, and creditors. Opening books, general journal. Date, details, folio, invoice, debit, credit. December 1st, building, debit. Equipment, debit. Motor vehicle, debit. Prepaid expense, debit. Debtors, debit. Bank, debit. Cash, debit. Bank loan, credit. Creditors, credit. When capital is not given, calculate assets minus liabilities. Capital, credit. Write a note showing the transaction. Assets and liabilities on opening new books of accounts. December 3rd, bought goods for resale on credit from A Limited with a list price less trade discount. Goods on credit, purchasers journal. Trade discount. This is a reduction in the price given for buying in large quantities. The purchase price is recorded in the purchaser's journal. Purchaser's journal. Date, supplier, folio, invoice, amount due. December 3rd, A Limited. Total purchases. December 5th, cash sales. Cash is received, cash book. Cash book. Date, details, folio. Discount allowed, cash, bank. Date, details, folio. Discount received, cash, bank. Debit, December 5th, sales, cash. December 6th, returned some goods to A Limited with trade discount on list price. Goods on credit, returns outwards journal. Returned goods with trade discount. When goods are returned, calculate trade discount on the returned amount. Returned amount $450 goes to the returned outwards journal. Date, supplier, folio, credit note, amount due. December 6, A Limited. Total returns outwards. December 8, sold goods on credit to B Limited with trade discount on list price. Goods on credit, sales journal. The sale price is recorded in the sales journal. Date, customer, folio, invoice, amount due. December 8, B Limited. Total sales. December 11th, deposited cash in hand into bank account. Cash gives and bank receives. Cash book. Credit side, December 11th, bank, cash. Debit side, December 11th, cash, bank. December 15th, B Limited returns some goods with trade discount on list price. Goods on credit, returns inwards journal. Goods returned with trade discount. Returned amount $400 is recorded in the returns inwards journal. Date, customer, folio, credit note, amount due. December 15th, B Limited, total returns inwards. December 17th, purchased goods from C Limited and paid with a check. Check is bank cash book. Credit side, December 17th, purchases, bank. December 19th, paid cash to C Limited for delivery of purchased goods. Cash is spent, cash book. Credit side, December 19th, carriage inwards, cash. December 20th, paid cash for salaries, light, phone and internet. Cash is spent, cash book. Credit side, December 20th, salaries, cash. Light, cash. Phone, cash. Internet, cash. December 22nd, customer paid in advance with a check for goods. Check is bank, cash book. Accrual matching concept. Accruals and prepayments must be shown in the current period to match accounts for which cash is owed or paid in advance. Prepaid revenue is an increase in the income account. It is a current liability as the business owes goods to the customer. In this transaction, payment for goods is made for the next period. Debit side, December 22nd, prepaid revenue, bank. December 23rd, purchased equipment on credit from D Limited, no goods, no cash, general journal. December 23rd, equipment account debit, accounts payable, D Limited, credit, purchase of new printer. December 25th, paid cash to A Limited to clear debt on December 3rd and received a cash discount. Cash is spent, cash book. Cash discount. Cash discount is calculated on the balance on the supplier's account after deductions. Discount received is recorded on the credit side of the cash book. 1350 supplier's balance less $81, discount received equals cash payment. Cash payment is recorded on the credit side of the cash book in the cash column. Credit side, December 25th, creditor A Limited, discount received cash. December 26th, received check from B Limited for goods bought on December 8th and gave them a cash discount. Check is bank, cash book. Cash discount. Cash discount is calculated on the balance on the customer's account after deductions. Discount allowed is recorded on the debit side of the cash book. $3,200 customer's balance minus $160 discount allowed equals check receipt. Check receipt is recorded on the debit side of the cash book in the bank column. Debit side, December 26, debtor, B Limited, discount allowed, bank. December 28, paid insurance for this period and the next period, cash is spent, cash book, accrual or matching concept. Accruals and prepayments must be shown in the current period to match accounts for which cash is owed or paid in advance. A prepaid expense is a decrease in the expense account that is recorded as a current asset. In this transaction, payment of insurance is made for both this period and the next. Credit side, December 26, insurance, cash, prepaid insurance, cash. December 29, received an invoice from Light Limited for due electricity bill, accrual or matching concept. Accruals and prepayments must be shown in the current period to match accounts for which cash is owed or paid in advance. An accrued expense is an increase in the expense account that is recorded as a liability. In this transaction, light was used and payment is owed. December 29th, debit, light. Accrued expense, light, credit. Electricity bill, due. December 30th, owner withdraws cash for personal use, cash is spent, cash book. December 30th, drawings, cash. December 31st, bad debts are written off and depreciation is charged. No goods, no cash, general journal. Prudence concept. Assets and profits must be shown at understated values so that users of accounting can see the true performance of the business. Bad debt written off shows accounts receivable and expenses at a realistic value. Here are two methods of writing off bad debts. 1. Direct write-off method. The debt is written off directly in the ledger and does not appear in the balance sheet. General journal. December 31st, bad debts, debit. Accounts receivable, credit. Account written off as bad debts. 2. Allowance method. A provision for doubtful debts is created and is shown in the balance sheet as a deduction from accounts receivable. General journal, page 2, December 31st. Income statement, debit, provision for doubtful debts, credit, entries to increase the provision for doubtful debts. Note, use the method given. Depreciation. 1. Straight line method. Also called fixed or equal installment method. Depreciation remains the same each year. Formula. Cost of fixed asset less residual value over useful life, number of years. Cost of fixed asset is 100,000. Useful life is 5 years. Residual value is $20,000. 2. Reducing balance method, also called diminishing balance method. Depreciation reduces each year. Note: use the method given. Recording depreciation. General Journal. Income statement, debit. Provision for depreciation, credit. Entries to depreciate fixed asset. Watch this video again or do the test now. Multiple choice. 1. What is the job of the bookkeeper in the accounting cycle? A. Journals, ledgers, income statement, cash flow statement. B. Source documents, ledgers, trial balance, balance sheet. C. Income statement, balance sheet, cash flow statement. D. Source documents, journals, ledgers, trial balance. 2. What is the job of the accountant in the accounting cycle? A. Journals, ledgers, income statement, cash flow statement. B. Income statement, balance sheet, cash flow statement. C. Source documents, ledgers, trial balance, balance sheet. D. Source documents, journals, ledgers, trial balance. 3. What are financial statements? A. Source documents, journals, ledgers, trial balance. B. Journals, ledgers, income statement, cash flow statement. C. Source documents, ledgers, trial balance, balance sheet. D. Income statement, balance sheet, cash flow statement. 4. Which item is capital expenditure? A. Depreciation. B. Paid insurance. C. Purchase of new equipment. D. Purchase of goods for resale. Five. Which item is revenue expenditure? A. Purchase of new motor vehicle. B. Fuel costs for motor vehicles. C. Installation of air conditioning. D. Expansion costs on building. Six. Which item goes in the sales journal? A. Bought equipment on credit from J Limited. B. Cash sales. C. Sent invoice to M Limited for goods bought on credit. D. Sold goods and received a check. Seven. Which item goes in the purchaser's journal? A. Received an invoice from SB Limited for goods. B. Bought goods for resale and paid with check. C. Purchased tools from D Limited on credit. D. Cash purchases. 8. Which item goes in the returns inwards journal? A. Returned office furniture to supplier. B. Sent back goods for resale to creditor. C. Issued a credit note for returned goods. D. Received a credit note for goods returned. Nine. Which item goes in the returns outwards journal? A. Returned office furniture to supplier. B. Sent back goods for resale to creditor. C. Issued a credit note for returned goods. D. Transported goods from the supplier. Ten. Which item goes in the cash book? A. Goods bought on credit. B. Accrued rent revenue. C. Salaries paid. D. Bought furniture on hire purchase. 11. Which item goes in the general journal? A. Goods bought on credit. B. Bought furniture on hire purchase. C. Salaries paid. D. Sold goods on credit. "12. What is trade discount? A. A reduction in payment by credit customers for paying on time. B. Discount allowed. C. A reduction in the price given for buying in bulk. D. Discount received. "13. What is cash discount? A. A reduction in price given for buying in bulk. B. Discount allowed and discount received. C. A reward for buying in large amounts. D. An invoice for less money for vast orders. "14. What is an accrued expense? A. Bought machinery on credit. B. Tenant owes rent for sublet. C. Paid next month's rent. D. Overdue internet bill. "15. What is an accrued revenue? A. Bought machinery on credit. B. Tenant owes rent for sublet. C. Paid next month's rent. D. Overdue internet bill. "16. What is prepaid expense? A. Bought machinery on credit. B. Tenant owes rent for sublet. C. Paid next month's rent. D. Overdue internet bill. 17. What is prepaid revenue? A. Tenant owes rent for sublet. B. Customer pays for goods not yet in stock. C. Paid next month's rent. D. Tenant pays some of the rent. 18. Which is the direct method of writing off a bad debt? A. Debit provision for doubtful debts, credit bad debts. B. Debit income statement, credit provision for doubtful debts. C. Debit bad debts, credit accounts receivable. D. Debit accounts receivable, credit bad debts. 19. Which is the allowance method of writing off a debt? A. Debit income statement, credit provision for depreciation. B. Debit income statement, credit provision for doubtful debts. C. Debit bad debts, credit accounts receivable. D. Debit accounts receivable, credit bad debts. 20. Which best describes the equal installment method? A. Reducing balance method of depreciation. B. Provision for doubtful debts. C. Straight line method of depreciation. D. Direct method of writing off a bad debt. 21. Which best describes the diminishing method? A. Reducing balance method of depreciation. B. Provision for doubtful debts. C. Straight line method of depreciation. D. Direct method of writing off a bad debt. 22. Which is the formula for straight line method? A. Opening stock add purchases less closing stock. B. Cost less trade discount. C. Percentage times residual value. D. Cost less residual value divided by years. 'What is your score? 1. D. 2. B. 3. D. 4. C. 5. B. 6. C. 7. A. 8. C. 9. B. 10. C. 11. B. 12. C. 13. B. 14. D. 15. B. 16. C. 17. B. 18. C. 19. B. 20. C. 21. A. 22. D. Label each transaction with the correct journal. Pause the video and record the transactions in the journals.